How did the world that was once trading goods like cows, wheat, and other commodities come to the standard of trading $7.5 trillion per day? I am Bassman Pro, and this is the Trader's Mindset. Let's meet after the intro. Welcome to the untold history of Forex trading. This is the Trader's Mindset, and I am Bassman Pro. In countries like the Roman Empire, Greece, and in the great parts of Africa, people used to trade using the bartering system. And how did the bartering system work for people in trading? For example, I would have my goods like goats or cows, and I would need some wheat or some grain in exchange of my goats or my cows. So in that scenario, I had to look for someone with wheat or grain and then give them my cow or my goat for them to give me their grain or their wheat. This is how the bartering system used to work. And in addition to that, there was another system called the commodity trading after the bartering system. How did the commodity trading work? People used to exchange commodities for commodities, and these types of trading were used on a small scale, like people would be nearer and close to each other to use this system. But here came a problem. People wanted to trade with countries and wanted to take trade in other countries, and this system couldn't work. This is how they introduced another system called the coinage trading. And coins would work like the medium of exchange by that time. So coins were made of silver, gold, and other commodities. So this coinage system was helping the people to trade by that time. And during that time, the Arabs could walk, the Chinese could walk with their coins and come to trade in the other countries. The Greeks could use the coin to trade. And as time went on, as trading was growing, coins were becoming like heavy to use in trading. You could find that traders and merchants were traveling a long way from countries to trade, and it could be difficult for them to carry coins across the seas. Pirates were all over the seas, bandits were all over the land, and the trading using coinage was becoming difficult. During those times when the coins were becoming too heavy for the traders and the merchants to move with the coins along the seas, China had a solution. The Chinese government had already introduced a system called paper money. And this showed that money was not supposed to be printed in gold or silver or in any other commodity, but it showed that money was just trust. And this paper system worked. The government could get the papers and sign on them, and they would use these papers in trading. Merchants in China were already using the paper money. But back in Europe, coins were still a standard medium of exchange used in trading, and the precious metals backed economies, especially when the European countries colonized and hoarded gold. But there was also a challenge. Also, gold had its limits, and it had its limits where it couldn't go in trading in the European parts. To solve this problem in Europe, by the 16th century, banks began issuing written paper promises, and they were given to the merchants, promising they would compensate them in metal when they were brought back. Merchants accepted them and they shaved. They circulated all across the countries. And again, using paper money and coins proved that money's power was not in the material it was made of, but the trust people put in it. But even when the world was trading with coins and the paper money which was given trust by the people, the question still stands. What really makes something to become money? What gives it value? What makes a certain thing to become trusted by the people and it is called money? In the book Politics by the Greek philosopher Aristotle, he explained what makes something to become money. He broke it down like this. For anything to function as money, it had to meet the 4 criteria. Number 1, it had to be durable enough for people to trust it in daily use. Number 2, it had to be portable so that it could be easily carried. Number 3, it had to be divisible. This was called divisibility, so that it could be easily divided. And number 4 was it had to be stable, and this was called stability. These were the 4 criteria for anything to function as money. Aristotle also defined the 3 roles that money must serve. And the 3 roles were these: medium of exchange, unit of account, and a store of value. Aristotle didn't invent money, but his system helped the world understand the framework of money and help people to exchange from the bartering system and the barter trading system to understand more value in the money and how to use the medium of exchange. But still, the world was still struggling with trading on a large scale, and Europe itself was still struggling with trading on a large scale, because moving with bags of money, gold across the sea and silver bags across the sea, it was dangerous. Pirates were all over the sea, bandits were all over the land, and this system of trading was still dangerous. This is when the Medici family came in. In 1397, the Medici family founded the first bank in the whole world. The Medici family introduced a system, and they introduced papers called bills of exchange and letters of credit. So merchants could deposit physical money in Florence, and they could get these papers of exchange and bills of credit, and later they were exchanged in real coins and real gold. Instead of carrying gold from Florence to London, a merchant could deposit gold and receive a paper called an IOU. In this system, the problem of carrying heavy coins and heavy money was solved because these papers were portable and they could help the merchants move with them, and they were recognized anywhere the Medici had branches. Even when the Medicis had introduced a good system, in 1880s, countries still faced another problem. How could countries use different currencies? Remember, each country had its currency, and they failed to keep the fairness, stability, trust when they were trading. So countries had to look for another option, another way of keeping fairness and trust. To solve this problem, in 1819, Britain made it official. They tied their currency to a specific amount of gold. The other countries followed: the USA, France, Germany, and Japan. They also tied their currency to a specific amount of gold. So countries were trading according to the specific amount of gold they had tied their currency to. And whenever they could print currencies or they could print money, they could not exceed that specific amount of gold that they tied their currency on. This system worked. Currencies became predictable and stable because they were all tied to something universal and stable. This was gold. And by the end of the 19th century, the world economy was running smoothly under the gold standard. By this time, currencies were stable, trade was flourishing, and people started believing that money backed by gold was secure and it had good security. But by that time, there came the World War. This brought another challenge on gold. During the World War I, as nations shifted from trade to war, the gold price and standard began to crack. As countries were forced to print more money so that they can facilitate their soldiers in the war, buy weapons, they couldn't wait for gold. So they had to print more money so that they can facilitate their soldiers in the war. By the end of the First World War in Germany, bread that was once costing like small money, people needed to carry wheelbarrows of money to just buy grain and bread. And inflation kicked and people suffered. After the First World War, countries tried to come back and gain stability on gold, but then came the Second World War. Still, economy went down and the gold standard was too down and it was low. It failed to raise on the standards of the countries on the world. After the Second World War, then gold collapsed. The gold reserves were drained. Then the world needed a new system and a new way of trading in the world. In Bretton Woods, the world economic minds gathered to design a new economic system, and they sat in Bretton Woods. This is what they came with after the meeting. They decided that every country is going to fix their currency to the United States dollar. And the US dollar was fixed and tied to a certain price of gold. This was done because the US had the most gold reserves in the world. And they also formed the International Monetary Fund, IMF, and they also formed the World Bank. This system helped to stabilize the economy and it worked for 30 years. After this system, then another problem came by the 1960s. The US was spending more money and billions on the Vietnamese War, and the other countries were busy making money, like Japan and the other countries like Germany. Europe and Japan were busy trading and they were getting most of the United States dollars, and they were holding them. Remember, the United States was in war with Vietnam and it was printing more dollars. And the Bretton Woods law was every dollar must be backed up by gold. And in that system or in that situation, United States found itself in a scenario that there were more dollars than the gold they had in their reserves. In 1971, the United States was on pressure. President Richard Nixon made a dramatic announcement. He suspended the dollar's convertibility to gold. And the moment that link was cut, suspending the dollar convertibility to gold, the Bretton Woods system collapsed. And because of this, currencies were no longer tied to gold. And since they were no longer tied to gold, they were determined by supply and demand. And things like interest rates, news could determine the currencies. Since then, that is how the Forex trading market was born. At first, Forex trading was a private club. And by this, only governments, banks, and huge institutions could play in the Forex trading market. As a retail trader like me, you needed access to the international and interbank market, connections, and huge number of capital. But now, by 1990s, everything changed just because of internet. things came in and retail traders joined the market. That was the history of Forex trading, and seriously, Forex trading has become a long way. All the way from trading cows, commodities, and grains to trading $7.5 trillion a day. That was Forex trading. Thank you for watching. This is the Trader's Mindset, and I am Bassman Pro. If you're finding value in this content, don't forget to subscribe, like, share, and comment. Thank you for watching. I love you. Peace.